I need help. I've got terrible cash flow. I need more of something. I need more credit, or I need more sales, or I need more time to fix my problems. Well, the reality is, a lot of companies, maybe even most companies, if they have a healthy business, can be fixed not with more, but with what they have when you start out and model cash flow and learn how to manage cash flow. Some of my most successful turnarounds have been when people don't have any credit left, their credit is ruined, and they can't get more sales quickly, and they can't deal with increasing prices to get better margins. They can't lower their costs. And what we need to look at is what is happening with their current cash flow. And then we learn and I teach them and we dig and we find out what is going on with their business that they can use the assets they have. And don't think accounting assets, think of all the things that a company has at their disposal when we talk about assets. And that's what we use to do a turnaround. Welcome to Cash Flow Confidence Live, where cash flow advisors and financial professionals learn how to become more confident at giving their clients advice that is low risk and can be shown and demonstrated to have a return on investment for each client with each strategy they implement. I'm David Safir, and I'm the founder of Cash is Clear Learning Systems, where we've documented over 230 cash flow strategies that can be implemented by any company, not all 230, but every single company I've ever encountered not only has a few, but dozens of cash flow strategies they can use to improve their cash flow and their profitability. Let's learn about model and manage. Well, it's an interesting thing because most people think that it's all about the numbers, and that's where it starts, is with modeling. Now, I'm not going to go deep into modeling today. Why? Because it's extremely technical and frankly, it's fairly easy to do. It's fairly easy to learn how to model a business's cash flow and go out. I've got resources, there's spreadsheets out there that you can go download, learn how to model. What is more difficult is to learn how to manage cash flow. But today I'm going to show you what to do and how to get started managing cash flow with the assets available to a company. So, where do we start? You model to predict the future, you see where the issues are, and within minutes, you can see where there's peaks and valleys. And as you're identifying the peaks and valleys, the whole trick is to say, okay, what can we move in from a revenue perspective? And revenue might not be typical sales, and I'll get to that in a minute. Revenue could be transforming non-traditional assets into cash. Non-traditional is not what you normally think of as cash, into cash, bring that in, and push out expenses and money going out the door. That's the goal, is to lower the peaks and push up the valleys so you're constantly above water as far out into the future as you can be. So, we're going to work with what you have. And I'm going to repeat the traps that companies run into. The we need more traps, and I'm going to explain why it's a challenge when you fall into the trap. We need more trap number one. We need more sales. There's a fallacy that says if I sell more, I will have more cash faster. The reality is, for most companies, when they sell, there is a delay to get cash in, anywhere from days to months. And I once ran a model on a contract that it was 6 months to start getting cash in. And it was more like a year to break even because they had to put out cash to get the business up and running before they could even start selling. Once they started selling, there was a delay in invoicing. Well, not the invoice, yeah, it was delayed because they couldn't invoice at the end of the month. And then it was a delay in accounts receivable. Most businesses, it is not instantaneous when you generate more sales. And there's a fallacy out there because there's so many people saying, let me show you how to increase sales and increase your cash flow. And the message is repeated over and over and over again, but you don't really know what the reality is until you model your cash flow. Trap number two, credit. I need more credit. Well, a lot of companies would love to have credit and more credit and more credit. And some companies need more and more credit to survive, in which case they might have a bad business model. But let's just talk about the typical company that is in need of a turnaround and is short on cash. Oftentimes, they've exhausted their credit. Credit cards are maxed out. Whatever credit lines they have are maxed out. Sometimes they've had late payments, and quite often, the credit of the business owner or owners is trashed. So you cannot get more credit. But here's possibly even worse: we need more credit, and you don't have a plan for what you're going to do with those funds when they come in to ensure you're just not digging a deeper hole. Real life example: a client I was working with got additional credit over $1 million and it was gone within 2 months and they were in the same problem. Now, I had predicted that. I had talked to them about it. I had shown them that that was going to happen. Why? Because I did a predictive cash flow model, which is what we talked about at the beginning. However, the bank asked for a predictive profit and loss statement. So everything looked great when you talked about accounting theory. Clients pay on time in theory. Reality is, clients, for this client, paid late. And we're not talking days, we're talking weeks or even months late. And it was on and on and on, where the theory of their accounting did not match the reality. So the bank gave a loan based upon the accounting theory and got blown up when their client couldn't pay them back in just 2 short months, when that $1 million plus credit line was gone. So credit is not going to solve the issue. Here is trap number three of, I need more cash, fix my cash flow. Time. Yep, everybody would love to have more time to fix everything. But the fact of the matter is, so many companies don't have more time. We're not talking years, we're not talking months, we're talking weeks. Some of my best turnarounds have been when I walk in and I'm told by the business owner, David, I've got $3,000 in the bank. I need to make a $10,000 payroll next week, and I don't know how I'm going to do it. This is a true story. And this is when I started my career doing this type of consulting, and I wasn't sure how to help him. But by the time payroll came around, he had twice as much as we needed. And by the time I ended the engagement, about 3.5 weeks in, they had $50,000 in the bank. And I won't get into it now, but time, we did not have that luxury. And most of the time you don't. So don't count on it. Number four, The trap that companies fall into is we need better margins, so we will slash costs and and we're going to increase prices. Those are the two ways you improve margins. Well, sometimes slashing costs that would work if you can get reduced pricing on your inventory, but you still have to sell what you already have. So that's a longer term solution. And as far as raising prices, go ahead. You can raise prices all day, but you only make the decision to raise the price, yes or no. You don't make the decision if when the customer walks in the door or looks at your website and says, wow, that price is up. I think I'll go buy a competitor. So, in theory, margins are great, but reality is you can't depend on them short term. So those are all the things that are trapping companies thinking that that's the solution. So what is the solution? You dig for gold with what you have. And I'm going to give you 6 places to dig for gold inside of a company that is facing a cash flow challenge. Number 1, it's sort of obvious. Number 1 place to look for gold for a client, for a company that is having cash flow issues is receivables. Receivables in many ways are golden, but the biggest issue is there's a short-term fix and then there's a long-term fix. Short term, you're going out and seeing who owes you money now, and you're simply making calls, especially if you do not have a system in place. If you've never made a phone call, if you've never said, hey, is there a reason you haven't paid me yet? Get on the phone or have your client get on the phone and just ask the question. Treat them like the client they are. You want an ongoing relationship. And so often, if there's no system in place, the answer is, oh my gosh, I forgot. Or I owe you money. I didn't realize. Let me get it to you. I have seen literally clients walk in checks. Business owners that I work with, their clients walk in with a check for $10,000 because they just didn't realize that they owed the money. And as soon as they were told, it was the same day. So receivables are golden. And if you need to, offer a discount. If you can pay me this week, then I would be glad to discount 5%. It is not a great long-term solution because that is extremely expensive. But it is a solution when you're facing a short-term crisis. Let's go on to the second source of gold, and that is inventory. I'm going to focus in on almost every company that has inventory has dead inventory. It's just not turning over. And we're not talking like it's 6 months old or a year old. We're talking last year's models, 2 years ago, 3 years ago. But they feel like it is gold that is worth what they paid for it and that margin that they should be getting. They need to get that 50% margin. Otherwise, they're not going to sell it. Well, it's your job to help them understand they've got a big problem coming up in a week or 2 weeks or in a month, and this is a solution. And if they take a loss, then, well, they're going to save some money in taxes. I'm not a tax guy, but I know that much. That and there's alternative routes to get creative to sell that inventory instead of the person who's your normal customer. Go look for alternate customers. Go go look for a competitor outside of the market who would gladly pick up some inventory at the right price. Go on to your local uh, for sale sites that, Craigslist or Facebook or wherever it is that things are sold in your community and put them out for sale there. under a different name, right? You don't want to trash your own market, but you get creative of how do you sell this dead inventory? And that's number two for where you dig for gold. Dig for gold in your fixed assets. There is a fundamental strategy that says don't buy something, lease instead. Well, in this case, you've already purchased. And so there's a second strategy that says sell with the lease back. Now, this is a certain type of asset. If you own a vehicle outright, or if you own a forklift or lift or other equipment that has an intrinsic value on the marketplace, there are leasing companies that will buy it from you and then lease it back to you at a monthly lease agreement. Now, that might not be great for the long term, and you might not want to do it, but it is an asset that you have at your fingertips that might be worth 10 or 20 or $100,000. And guess what? You don't have to sell the whole thing. Or, you ready for this one? If it's free and clear, go get a loan on that asset. Or if it's not free and clear, but you've got some what would be called equity in the real estate world, so that it's worth $20,000 and you only have a $5,000 loan on it, go refinance, pull out another $5,000, pull out another $10,000, and get yourself out of the short-term trap. Now, again, go back to the model. Every time you implement a strategy, plug into the model what the impact is, not just short-term of the cash coming in, but if you have to make monthly payments, how does that impact your cash flow? All right, fixed assets. Number 4, off balance sheet assets. Off balance sheet assets can be a gold mine to a company. What are off balance sheet assets? There's 2 types. Number 1 are the assets that a company has taken in that literally never get recorded. I've worked with a client who traded product for product. Don't ask me what they did in the past, how they recorded it, but they never came onto the balance sheet. And the way I found it was I was walking around the yard and I said, "What's that?" And it was an enormous generator the size of a train car. So, yeah, that was taken in as in trade. And they were in a cash crunch. And I said, "Well, why don't you sell that?" And the answer was, "I don't have the time." And I said, "You're telling me that you are at risk of losing your business and you don't have the time to sell an asset that is worth 2 or 3 months worth of debt payments?" That opened his eyes and they started selling it. And you can liquidate those things. There's always specialty companies that need these types of assets. Won't go into the details, but that's a beautiful one. Type of off balance sheet asset number 2 is anything that is paid in full but doesn't show up on the balance sheet because it's been completely depreciated. Let's go back to that automobile. It doesn't show up on the report because it was fully depreciated. So it was a zero balance sheet value, and you filter out for anything that's a zero value. Why bother looking at it? It just clutters up your balance sheet. But somewhere or another, if you can figure this out, that's a great way to go. And it could be things that were expensed and never showed up on the balance sheet because you can expense a certain amount. Okay. Number 5 on where to dig for gold within a company. Payables to large companies. Why large companies? I protect small companies. But large companies, we're talking the telephone company, the gas company, the electric company, etc. They will allow you to slip a payment for very low cost or zero cost for a month. Now, you need to go verify that that's the case. But if it is, those are the payments that you might be able to push for a month or two. Now, they might not add, any given one might not be very large, but you add them up and you might be able to get some decent debt relief. The other one is a rent or mortgage only up to the point that you're going to hit a penalty. Why? Because those penalties are generally very big. But if your mortgage is due on the 15th and you need to push it out to the 14th. Number 6, for where to find gold within a company's assets. Assets are anything that's available to use as a lever to a company. And the last one is number 6 for finding gold is look at your suppliers. Look at your suppliers and figure out which ones don't you have credit with and get credit. Look at ones that you have credit with and ask for additional credit. Now, it can come in one of two ways. Number one is the size of the credit line, and the other one is the terms, how many days you have to be able to pay. That is number 6. And with those combined, it gives enormous opportunity to turn around and generate significant additional cash flow by managing cash flow. Here's the key: nothing will change unless there is focused, continuous effort to change and modify any of those things that I've just talked about, to implement strategies and to make things happen. All the theory in the world doesn't do anything without action. But more than anything else, when you start to implement, two things will happen to a business owner who have become discouraged, depressed, and quite frankly, hopeless. As they start seeing the possibilities, they will start to have hope. And that makes all the difference in the world for the survivability of a company and the ability to generate additional cash and eventually additional profit. And as you implement even one strategy and they see the reality that they can get, they can move forward, they will start having faith that things will get better and that you are the trusted advisor that they need to help them grow their business by having strong cash flow and strong profit. I'm David Safir. Until next time, be the confident advisor that your client wants, needs, and deserves.